The Fed is really panicked. I think it's too little too late. The housing market in China has literally collapsed.
Dr. Shilling, asset allocation, how would you be positioned going into 2025?
Well, I can tell you, we manage money, and I can tell you how we're positioned. We're long.
We're pleased to welcome back Dr. Gary Shilling, president of Gary Shilling Co., formerly the chief economist at Merrill Lynch. He served on many senior positions on Wall Street for several decades, and he's a legendary economist, having been ranked as one of the top institutional economists by several magazines and publications. Welcome back to the show, Dr. Shilling.
Glad to be with you.
Let's start by talking about some recent economic news that came out today on the 26th of September. If you take a look at my screen now, we have U.S. weekly jobs coming in today, this morning, at a multi-month low, 4-month low, reporting by Reuters here. Corporate profits revised up. All weekly jobs claims fall by 4,000 to 218,000. Continuing claims increase 13,000 to 1.834 million. Corporate profits revised slightly higher in second quarter. So the equities markets reacted to today's data by being slightly in the green. How are you interpreting this week's information? Are you we'll get into some other information in just a bit, Dr. Schilling, but it seems to me like the just by the trend here, the weekly jobless claims have been falling for quite some time. Is this the beginning of renewed hiring activity?
I don't think so. I don't think so. As a matter of fact, you look at businesses, and particularly in the tech area, which is very volatile and a good indicator of things to come. But they had immense hiring during the pandemic, and I think so far this year there've been 137,000 job cuts in the tech sector. So they've really reversed gears, and I think what's happening is that there is a lot of unwinding from the pandemic. Now, in the meanwhile, of course, you have some industries that are looking for more people, but you look at a lot of the indication, the people are more inclined to stay with their jobs. Quit rates are down. People don't want to quit because they may not get new jobs. You look at job openings; they have declined, and the labor markets are definitely getting softer. So, you as usual, you can't look at any one set of weekly numbers and conclude what that's going to happen. But I think there's a pretty clear pattern of softening job markets, and that's really the main reason I think that the Fed has shifted gears from this engraved in stone target of 2% inflation to now cutting their reference rate by 50 basis points.
Yeah, let's talk about the 50 basis point cut since you brought that up, Dr. Schilling. What was your initial reaction to last week's cut? Before the week before that, several days before the actual meeting, the FOMC meeting, the CME Fed Watch Tool in the markets had anticipated broadly a 25 basis point cut. It wasn't until a few days before then that odds started shifting towards a 50 basis point cut, which is ultimately what they did. Did that move surprise you at all?
In the sense that it suggests the Fed is really panicked because they had this engraved in stone 2% inflation target, and all other major central banks in the West had the same 2%. And of course, now we've seen cuts in bank rates in Canada, in the UK, in the European Central Bank, and now the Fed. And the fact that they not only reversed gears before inflation got back to the 2% that they had targeted. Before that, the fact that they went 50 basis points rather than 25 tells me they're pretty worried about the labor markets deteriorating and not just stopping at go, but going into recession.
Before we continue with the interview, I'm going to tell you about another way you can invest your Bitcoins and store them safely instead of using a traditional wallet or an exchange. Consider an IRA. Today's sponsor, iTrust Capital, is one such IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1% only. And being an IRA, it also offers unique tax benefits. If you'd like to get started and learn more, click on itrust.capital/David in the link down below or scan the QR code up here. If you're over 18 and you want to open a new account with cash or roll over an existing account, you can do so using my referral link. And if you use that referral link, you'll get $100 in signing bonuses. Okay, the labor market has been, if you just take a look at the unemployment rate, it has been deteriorating. So it's now at 4.2% was the latest reading. I'm getting several interpretations of this, though, Dr. Shilling. Some say that this is due to the expansion of the labor force, primarily from immigration. It's not actually showing deterioration. What's your interpretation?
Well, some of it is, but the numbers, if you look at them as reported, it's a relatively minor amount growth of the labor force, less than 1% from immigration. But the point is that immigration is a soft number because there's a lot of illegal people coming into this country that probably don't get counted. And of course, another thing that is confusing it is that people have multiple jobs. Now, supposedly the Department of Labor Statistics, Bureau of Labor Statistics, corrects for that, but you don't know whether they take them all out. In other words, if they count people with two jobs as two people. So it's the whole statistics is a little tough to interpret. But I think when you look at not only the unemployment rate, but you look at the job openings data, you look at the quit rates, you look at a whole host of labor statistics, it says that labor markets are definitely softening. And I think that was primarily the driving force behind the Fed's cut of 50 basis points.
Okay. The Chair Jerome Powell did use the word softening, like you said. At what point along this unemployment curve did the Fed possibly come to the conclusion that the labor market needs to be prioritized in their decision-making process, or that it's softening? Was it at 3% unemployment, 3.5 before it hit 4% unemployment? Basically, viewers would like to understand, how that conclusion is made.
Oh gosh, I don't know. I'm not sitting in on the FOMC meetings, obviously,
Okay.
uh, but I think it's sort of been a growing concern, and of course it's a two-edged sword. One is the increase in the unemployment, softness of labor markets, and the other is that inflation has come down. Now, inflation is still above the Fed's target. It's running about 2.5%. The Fed had this vehement desire to get it down to 2%. And by the way, I don't know why they picked 2%. They've never really explained that in to my satisfaction. My speculation, and I use that word deliberately, is that they were worried about deflation back before the pandemic. That was the concern. Was you're going to slip into deflation, and in deflation, what happens is that you get a self-reinforcing downward spiral because people are waiting for lower prices to buy, and inventories pile up, excess capacity pushes prices down. Suspicions are confirmed, people wait even longer. And my suspicion is that the Fed was so fearful of that they wanted to have a cushion. They wanted 2% inflation just to protect themselves against deflation. But for whatever reason, the Fed and all the other major central banks zeroed in on this 2% target, and were vehement on it until just really a few months ago. Well, some of the other central banks started well before the Fed, a month or two earlier. But I think that the abandonment of that whole strategy, and they've never really explained why they did that. But I think it's clear that they're worried about the labor markets.
I have a question about the GDP and GDI revisions that came out today. So, how could you explain what how would you explain the differences here? So first of all, the GDI, which measures economic activity from the income side, increased at a 3.4% rate last quarter, revised up from the initially estimated 1.3 pace. Um, it rose at an upwardly revised 3.0% pace in January and March quarter. GDP also came in second quarter 3% unrevised. How would you explain an upward revision in GDI and earlier last quarter, an upward revision in GDP as well, when the labor market is showing signs of deteriorating? Can you help us understand this?
No, I think a lot of those things are technical
Okay.
factors, and it takes a lot of time and minutia to explain them. But I don't put a lot of concern on it, really.
Are you expecting the Fed then to react to this deteriorating labor market with sustained aggressive rate cuts, which is to say more 50 basis points, perhaps even 75?
They probably will, but of course the upcoming election gives them pause because they never want to look as though they're being swayed by political considerations. So if they're going to cut again, they're going to have to do it pretty quickly because we're getting what 5 weeks away from the election. So they really don't have much time. But they could cut again. If they did, I think you'd only interpret that they're getting really scared. Otherwise, they probably would wait till after the election, late November or December.
The FOMC dot plot stated that the median projection, I think, for next year was 3.4%. The markets are projecting a cut all the way down to three and a quarter, perhaps even 275, which is slightly lower than the Fed's median expectation. We're looking at a 200 basis point cut, basically from current levels. Does that make sense to you in a year's time?
It could if the economy continues to soften and and unfolds into a recession. But I would caution our viewers that the forecasting record of the markets and of the Fed participants are not very good, to put it euphemistically. So I wouldn't. I never get too excited about their forecasts because they haven't been close enough to be a very reliable guide.
Some pundits and economists have compared this cycle to 2007 when the Fed cut then. Remember that the Fed cut in 2007 before the Lehman collapse. Stock markets at the time in 2007 were still making new all-time highs. And of course, the labor market was just starting to deteriorate, not aggressively until after 2008. Are we showing any signs of repeating 2007, Dr. Schilling?
It's a different situation. I mean, back then, of course, the culprit was the subprime mortgage lending, and it was a very pervasive malady in the economy. And people were convinced that they could buy houses, take out more big mortgages, over 100% of the cost of the house when they added in home improvement loans, and they never have to pay a dime because the price of the house would escalate to the point they could refinance uh, before the first mortgage payment was due. I mean, it was really a fairyland. We don't have anything like that now. We do have problems with commercial real estate, as I'm sure you're aware. The office market is really in trouble because people have been working from home. There was a lot of excess building. Um, this is an area like all real estate, which is highly financially leveraged, and that means it's very easy to get overblown in that area. But that's not big enough. Yeah, there people are getting hammered on this, but it's not big enough to, in any sense, rival what happened back with a subprime mortgage. So I think it's hard to use that as an example of what's going on today.
Well, speaking of the housing market, today's pending home sales data came in, hover near record low in August. So contracts to buy U.S. previously owned homes edged up in August from July's record low as a drop in mortgage rates uh, it, in anticipation of federal fund benchmark rate cuts, provided a modest lift to affordability. I think the general question is how the housing market is going to react to a 50 basis point cut. Presumably, mortgage rates would drop. And as you recall, Dr. Schilling, in the last couple of years, a lot of people have held off selling their homes because rates were too high. They didn't want to refinance at a higher rate. Now that rates are coming down, perhaps we're seeing more selling pressure. Is that possible?
Well, there are a number of factors that are involved here. There's the as you're noting the question of are people willing to sell? Because a lot of people before the pandemic had 3 and 4% 30-year fixed rate mortgages. Well, mortgages got to be more than twice that much, and so anybody who was going to buy another house really was dissuaded because they would have to take out a much higher mortgage, higher monthly payments, and so on. So that's one aspect. Now that is obviously easing as mortgage rates come down with interest rates retreating in general. The other side of the coin, though, is that the price of housing has gotten to the point that affordability is a major problem. You look at for example, the National Association of Realtors measure of affordability, which takes into account mortgage rates, but also the prices of houses and incomes of potential buyers, and that continues to be very low, is unaffordable. So it's the mortgage rate declines are some help to housing, but you've got these other factors, and I don't think you've got any boom coming up anytime soon.
I like to talk about China towards the last part of our interview, but before we move on to China, let's close off on U.S. domestic markets. Ultimately, then, Dr. Schilling, what is your outlook for corporate earnings and where the equities markets may be headed towards the end of the quarter, into next quarter, into 2025?
Well, the corporate sector is has been doing well, and I think will continue to as long as the economy holds up. Now, that's really the $64 zillion question, because you do have the possibility that the economy will continue to deteriorate as labor markets ease, and whether this takes all the way into recession or not, it remains an open question. But corporate profits, I think, are probably, in view of softening economy, are probably about as as uh, as good as they're going to get. One of the things you look at consumers, for example, consumers are over two-thirds of GDP is accounted for by consumer spending, and people have been spending at a greater rate than their incomes. Why? Because the saving rate is going down. And the saving rate is going down. It means spending is increasing faster than incomes. Well, you've got a saving rate now of below 3%. And I don't think that, in other words, I don't think you have that as a spur to the economy anymore. So I think the economy is uh, easing enough. Whether it's going to go all the way to recession remains to be seen. But I don't think you can see a great spur in corporate profits.
Savings rate has been coming down. Has the savings rate historically been a leading indicator for consumer spending and
No,
retail
it no,
sales?
it's pretty much coincident.
We're currently growing. The economy is growing at 3% GDP, like I stated earlier. Going into a recession, assuming that we need a quarter of negative GDP growth, that would imply a 3% contraction at least. What would the shock need to be to get us there?
It could be a distinct shock. Now, like in the 07, 09 major recession, it was a collapse in subprime housing. If you go back to 2000, it was a problem with growth stocks, and they were going to the moon. You can have these special factors. I don't see any major trigger, but you have had times when it's just a matter that things get top heavy, and that could be the case now. As I say, you've had a lot of speculation. You look at all the Bitcoin area, the Magnificent Seven, the Nvidias, and so on and so forth. you've had a tremendous amount of speculation and a narrowness in the stock market, which to me is a very distressing sign because it says people are not interested in the general economy. They're not buying the bulk of stocks, they're buying specifically speculative areas. So it's one of the things that says to me that maybe there is a sleeper weakness in the economy here that just isn't completely revealed, but will be.
And how do you feel about fixed income with the Fed funds rate coming down? Will the 10-year follow?
Yeah, sure. What happens is that um, the Fed operates with the overnight Fed funds rate. Um, Now that effects of changes there spread throughout the yield curve, but with decreasing intensity. And as a matter of fact, when you get out to 30-year bonds, Treasury bonds, their main driver is inflation. It's so far from what the Fed does that, well, our work shows that about 70% of the volatility in 30-year Treasury yields is caused by inflation. The Fed the Fed can have effects on the inflation, of course, but in terms of a direct effects, it's relatively minor. So I think you've got to be careful about assuming if the Fed is cutting that's good news for everything on the Treasury curve, and of course then you've got the huge spectrum of fixed income beyond that, munis, corporates, and so on.
Okay, let's finish off then on China. So China, as you know, earlier this week unveiled what some newspapers are reporting as the most aggressive stimulus package since the pandemic. Not only are they cutting the benchmark policy rate, but they're also introducing several policy measures to stimulate the property market. For example, here it says the property market support package included a 50 basis point reduction on average interest rates for existing mortgages and a cut in the minimum down payment requirements to 15% on all types of homes. As you know, there was a property bubble that bursted not too long ago. Like it says here, the property market has been in a severe downturn since peaking in 2021. How significant is the stimulus package for not just China, but also the rest of the world's economy, Dr. Schilling?
I think it's too little too late. The housing market in China has literally collapsed. You did have this, the Chinese households have very limited investment opportunities. They can't really move money abroad. They don't trust the domestic stock market, and property has been their big source of investment for savings, and they are prodigious savers. Much more they save relative to their incomes. They save about 3 times as much as Americans. Now we're pretty lousy savers, but maybe that's not saying too much. But anyway, they had a huge bonanza in housing, apartments. That people don't, very few single family houses, but the thing is that people were putting money down on apartment buildings that hadn't even been started. And you had some of these firms like Evergrande, which literally collapsed. They took in all this money. They didn't deliver the apartments. It stuck households. So you've had a real collapse in the housing market. Now, what will it take to bring that back to life? These measures may help, but I think they're a long way from reviving it. The Chinese leaders in Beijing have said repeatedly, houses are to live in, not to speculate. And President for Life, and that's what I call him, Xi, is very, very, he doesn't really care much about consumers. He's looking for industries, computer chips and green energy and so on, where China can have global domination. So I just don't think that there is that commitment that's going to revive what has been a disastrous collapse in the property sector in China. They obviously are doing something now, but as I say, I think it's too little, too late.
Do you think that the Chinese economy has helped export deflation, as some people have said, and thus helping
Oh
the
yeah,
Fed with
very,
their
very,
job?
very, yeah, very definitely, and of course that has enhanced by the emphasis on exports, which has caused a lot of problems, in Europe and the U.S., uh, resulting in higher tariffs and so on. Because whether there is dumping in the legal sense or not is not the question. The point is that China has been flooding the world with low cost exports, and of course, domestic producers in other areas have to follow suit, or they lose market share to China. So I think it has been exporting China. The basic reality is today we've got a world where supply exceeds demand. Now that's a broad statement, but China is a big part of it. It's not the only part, but it is a big part. And when you've got more supply than demand, what do prices do? They go down. It's just the reverse of when you have more demand than supply and prices go up. So yeah, they have been exporting deflation. Whether this becomes a global phenomenon in terms of actual declines in prices on a worldwide basis, that remains to be seen. But it's certainly been a very deflationary effect.
Well, do you think dovish policy from the world's second largest economy would influence central bank decisions from other central banks, particularly the Fed?
Yeah, of course, they all claim that they don't, well, particularly the Fed, they claim that they don't pay attention to what anybody else is doing, but they do. They can't, they
I
can't
I,
avoid.
I, I had Jim Bullard on their show on record saying that they don't coordinate, but they do talk, they communicate. So
Yeah, yeah. And yeah, these guys are not sitting in hermetically sealed bubbles. Um, yeah, I think that's true. And I think the weakness in China is one of the factors that the Fed is taking into account, and the ECB and the Bank of Canada and the Bank of England. I think it's one of the factors is taken into account as they cut rates, because they realize that you don't have the excess demand world like we had earlier, which propels prices and is basically what is behind inflation.
well, that would probably mean then, I'm just speculating that the other central banks uh, would abandon any hawkish stance whatsoever for fear of interest rate differentials widening and their currencies going up too much relative to the yuan or other currencies.
Well, I think they already have. I mean, if you look at it, the U.S. is following, not leading the parade. You had Bank of Canada, the Bank of England, European Central Bank, Swedish Reichsbank. Um, you've had all these. Japan has shifted its gears. They operate a little differently, but all of them have really moved toward the east. The Fed is really at the tail end of this parade.
So then, final question then, Dr. Schilling, asset allocation, how would you be positioned going into 2025, given the discussion we've had so far?
Well, I can tell you, we manage money, and I can tell you how we're positioned. We're long treasuries, bonds, and the reason is that I expect rates to go down, and so I'm in it for appreciation. I don't care what the yield is as long as it's going down, because the price of the prices goes up, and the longer the maturity, the more bang per buck you get for a given decline in yields in terms of price appreciation. We're also along the dollar, and the dollar-like treasuries are safe havens. And in a world that's confusing, and we haven't talked anything about Ukraine, but that's and what's going on in the Middle East. Those are very disruptive forces, and again, they make the dollar attractive. Um, we're short commodities. I think the world is is easing. You've got an excess supply situation, so commodities I think are going to continue to be weak, and we're really avoiding stocks. I just you've had a big run in the S&P. Although it's interesting, if you correct for inflation, and we're looking at it from 2019, before the pandemic, um, the inflation corrected S&P is up only about half what the nominal GDP S&P is. It's interesting. Stocks, and I think this is the perennial bullish sentiment. People want to have the highest number possible. Now, nobody ever talks about nominal GDP. It's real GDP, but why not real stocks? But in any event, they have been affected by by inflation.
Well, how do you feel about defensive sector? So take a look at my screen now, Dr. Schilling. I'm showing a chart on a 3-month time horizon. So the last 3 months of the XLU, which is the Spider Utilities ETF. So if you just overlaid that with the S&P 500, over the last 3 months, the XLU has outperformed by a tremendous margin, 16% versus 4.5%. If you replace the XLU with something like the consumer staples sector, which is XLP, that's also outperformed the S&P 500. So people are rotating into defensives. How do you feel about that?
Yeah, I think that's true, and that's been our recommendation. But the interesting thing is that if you look at the so-called defensive sectors, utilities, consumer staples, um, they if you get recessions, those stocks on average go down. They don't go down as much as the overall S&P, but they do decline. They are defensive, but they're not foolproof.
How do you feel about dividend stocks as hedge against lower yields?
Well, yeah, I think that makes sense, and of course that's part of the appeal of utilities, uh, and and certain consumer staples. Yeah, they tend to pay higher dividends.
I don't think I've ever asked you about Bitcoin. We'll finish off here. What is your sentiment on Bitcoin over the last year? It's done tremendously well. Just in the last 3 months, up 20%. Year to date, up 54%. In the last 12 months, up 150%. It's more or less tracked the Nasdaq, but with a looser correlation now recently. But do you have any thoughts on
Well,
Bitcoin?
yeah, I mean, you've got Nvidia, you've got Bitcoin, this whole speculative area, and I think what's happened there now, there is, there is some. I mean, Bitcoin is a pure fiction. There's nothing behind that. Nvidia, you can say, hey, there is something behind AI, but um, I think the reality is that the Fed and the federal government pumped a lot of money out into the economy in reaction to the pandemic, and it didn't get spent by and large, and a lot of it I think went into these speculations. So you had a big a big enthusiastic response there. Now, whether that is sustainable or not, I think is highly questionable. But it certainly was there, and you had a feeding frenzy. But we've seen this before. We saw it with dot-com stocks in the late 90s. We saw it with housing, as I mentioned early, in the subprime mortgage bonanza. You get these periodically, but I would not be long those stocks at this point.
Okay, very good insights. I appreciate you updating us. Dr. Schilling, where can we learn about you, your work, your company?
Well, you can visit our website, which is www.agaryshilling.com, and it's AGARYSHILLING.com. If people would like to get a sample copy of our monthly newsletter on a gratis basis, they can also call our toll-free number, which is 1-888-346-7444. 1-888-346-7444. And we talk about economic development. So the current issue, which is about to go to press, is talking about the longer term outlook for world economic growth. What are the factors that are going to drive it up, and what are those that are going to retard it? But we also have in there every month our investment strategy and recommendations. So people are interested in that, just give us a call.
That's a very interesting piece of work. When does that report come out?
Well, we're just it's going to go to press tomorrow morning,
Okay, wow. All right.
and
Okay.
our and most of our subscribers now get it online, so they'll have it by noon tomorrow.
Can you give us a teaser just in 30 seconds or less? How do you feel about global growth? We talked a lot about the US and China, global growth overall. The Eurozone has been slowing down. What's your outlook?
Well, there are three sectors that are slowing down. One is China. We talked a little bit about that. The second one is U.S. consumer. We talked a little bit about that. And the third is Europe. On the other side, I think the technology sector is growing. These new technologies start from zero, even though they're growing at triple digit rates. It takes time for them to get big enough to move the overall economic needle. But it's interesting that Mario Draghi, who was the previous head of the European Central Bank, just came out with a very interesting report recommendations on the euro on Europe, and that's what he is saying, which is obviously that Europe lags behind in terms of productivity growth because they've had a very low involvement in high tech compared to the U.S. Um, and I remember this last trip I had to France. I mean, they enjoy the good life, 3 hour lunches and so on, and 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 but it's a different lifestyle, and it just does not compete with the U.S. Um, and Draghi, who is, by the way, um, he's got a PhD from MIT in this country, but he's come out with a very specific recommendations that really say that Europe's got to get its act together and emphasize and emulate the U.S. in terms of productivity growth with tech. So I think tech is a big plus. As I say, you've got drags on the other side, Europe, U.S. consumers, and China.
All right. Well, follow GaryShilling.com to stay up to date on his work and perhaps get a copy of this report. I thank you very much. I appreciate your
I'm
time
delighted to
today.
be with you, David, and look forward to doing it again.
Yes, absolutely. Look forward to it. And thank you for watching. Don't forget to like and subscribe.